Real estate investment trusts are today priced at their lowest valuations in over a decade, with many individual REITs trading at large discounts relative to the fair value of their properties. Their valuations have gotten so low that you now even have the big private equity players like Blackstone, Brookfield and Starwood aggressively going after REITs. Just recently, Blackstone announced that it would acquire Apartment Income REIT in a massive $10 billion transaction, and this came just a few months after it announced that it would acquire Tricon Residential, another REIT, in a $3 billion transaction, and in total it has now acquired over $40 billion worth of REITs since the beginning of this REIT bear market. Then Starwood, on the other hand, bought more shares of Camden Property Trust in the last quarter, and its billionaire CEO Barry Sternlicht just recently made the following comment about the REIT sector. There are some unbelievable bargains in REITs. We did the same during the pandemic. We bought a dozen stocks all over the world and we had a 70% IRR on that stuff. We're already buying some stuff today in the public market. That's what he said in a recent CNBC interview. And it's pretty simple to understand why Blackstone and Starwood would be so bullish on REITs, because after all, today they essentially allow you to buy real estate at a large discount to its fair value, and historically REITs have always recovered from every bear market and richly rewarded those who had the courage to buy them while they were discounted. And I think that the reason why they are now becoming more aggressive with their REIT investments is because the window of opportunity could be closing. See, the only reason why REITs are today discounted is because the market feared that we might be going into a higher for longer interest rate environment, but now as inflation continues to cool down, it's widely expected that interest rates will also return to lower levels sometimes over the next year. Of course, no one can exactly predict when interest rates will be cut, but according to the Fed Watch tool, it's quite likely that interest rates will be about 100 to 150 basis points lower over the next 12 to 18 months. This bodes really well for REITs in general, and especially so for some individual REITs that are very severely discounted. Hey everyone, this is Yusha. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to talk to you about two once-in-a-decade REIT buying opportunities. But before I get started, can you please do me a huge favor and click the subscribe button? We're getting close to the 20k subscriber mark and I'm trying to break that before the end of this month. Thank you so much in advance. So the first REIT I'm going to discuss here is called EPR Properties. Its ticker is EPR. This is my favorite net lease REIT. It's different from most others like Realty Income, NAREIT, Essential Properties Realty Trust, and so on, in that it focuses on experiential properties such as movie theaters, ski resorts, golf complexes, entertainment parks, and so on. This unique approach of targeting experiential properties has historically been very rewarding for EPR because there's relatively little competition for these assets, and this has allowed EPR to buy them at higher cap rates and with better lease terms. I'll put a chart here on the screen where you'll see that EPR has earned over 2 times higher total returns than the REIT benchmark since it went public, and I don't think that this outperformance is going to stop anytime soon, because to this day most net lease investors will rather avoid experiential categories because they have more uncertain releasing prospects in case of vacancy. It is true that these properties are a bit riskier than what these other net lease REITs like Realty Income are typically targeting, but EPR is able to make up for this by then structuring stronger leases with master lease protections and focusing on the higher end of the experiential real estate market, having stronger tenants, and then it's also able to, of course, mitigate risk by owning a large and diversified portfolio of experiential properties. But the interesting thing here is that despite having this amazing multi-decade track record, EPR is today priced at one of its lowest valuations ever, at just around 8 times FFO and over an 8% dividend yield. I think that there's one main reason why the market has priced EPR at such a low valuation, and it is that its second largest tenant is AMC, representing about 14% of its revenue, and the market fears that AMC is going to go bankrupt, forcing it to vacate some of these properties, and this could lower EPR's future cash flow. But I think that this risk is greatly misunderstood because, for one, the AMC lease has already been renegotiated. Then for two, Regal, which is another movie theater operator, recently went bankrupt, and when it renegotiated its lease with EPR, it actually resulted in a rent bump rather than a rent reduction. And then the third thing to consider is that EPR's movie theaters are today already as profitable as they were prior to the pandemic if you look at the profitability on a property level basis. Then the fourth thing to consider is that AMC has been able to sell a lot of shares to raise new equity capital, and it may just as well keep doing that, so it's far from certain that the company is going to go bankrupt. And then the fifth and most important thing here to consider is that EPR owns some of the highest quality movie theaters in the nation. There are those that are the most productive, and these are not the theaters that are closing down. What's happening here is that, yes, the theater market is a bit oversupplied, so you have lower quality, less productive theaters closing down, but then this leads to traffic consolidation. All these people that used to go to these lower quality theaters end up going to the higher quality theaters of EPR, and that is why even today, as we are still recovering from the pandemic, its theaters are already as profitable as they were in 2019. This also means that AMC is unlikely to want to vacate these assets, even if it has to go through a debt restructuring, because these are some of AMC's most profitable assets and they're absolutely essential for the company to operate its business. But don't take it just from me. EPR just recently attended the Citi Global Property Conference, and there was an interesting exchange between an analyst and the CEO of EPR Properties concerning the AMC risk. The analyst essentially was asking what they expect would be the impact if AMC would file for bankruptcy, and here's what the CEO of EPR responded to this. We are very comfortable with that our lease would hold up. Again, you probably wouldn't hear this from most landlords, but beginning of 2020, we've been encouraging AMC to file. Again, because clean up your balance sheet. The business is recovering, the business looks nice, but you have a bad balance sheet. So we have already done the restructuring with them. Like I said, we did it back in 2020. We are very comfortable with how we are going to end up as a result of that. And then he still added that we'd just like them to go ahead and get it done because that's how comfortable we are with our lease structure and how important our assets are to them. So essentially what EPR is telling is that they would benefit if AMC files for bankruptcy because their lease would likely remain more or less intact, but would allow AMC to cut down a lot of its debt, which would then also free up a lot of capital for AMC to reinvest in the theaters and allow it to recover at a faster pace. So with that in mind, it seems very logical for the market to price EPR at such a large discount just because of this one risk factor. The management of the company actually doesn't think that this is even a risk. They think that this is an opportunity that would benefit them. But it's obviously true that if AMC was going to file for bankruptcy tomorrow, it would lead to a lot of very negative headlines, and it would likely lead to a lot of volatility in the share price of EPR. Most market participants are short-term oriented and they're trying to avoid owning EPR on the day that AMC files for bankruptcy, and this is why there is so little demand for the shares of EPR and explains why it's so heavily discounted today. But I think that this is an amazing setup for investors who can focus on the long-term fundamentals of the company and ignore the short-term noise. EPR just recently hiked its dividend by another 3.6% and guided to grow its FFO per share by 4% this year. It also noted that it should be able to keep growing its FFO per share by roughly 4% annually, even without having to access the capital market. Moreover, they can drive this growth all while at the same time keep improving the average quality of their portfolio by selling some movie theaters to lower their exposure and keep reinvesting in other categories that are more desirable. Today, they are getting roughly 8.5% cap rates on their new acquisitions, and the management recently noted at the same conference that they should be able to sell some of their movie theaters at roughly the same cap rate, so there will be no delusion in them selling movie theaters to buy other properties. Just a few years ago, they generated about 41% of their rental revenue from movie theaters. Today, this is down to 37%. By the end of this year, it should be down to about 35%. And the management expect to bring this down to about 15% over time. And I think that this is important because this could be the ultimate catalyst that will lead to a re-rating of the stock of EPR Properties. Reducing this exposure will remove the primary fear of the market concerning EPR, and this would also justify a higher valuation multiple. And that improvement in portfolio quality combined with some cuts to interest rates could easily lead to a recovery to roughly 12 times FFO. EPR would still be priced at a discount relative to its peers, and yet this would result in about 50% upside from here. While you wait, you also earn a 8% plus dividend yield, and the company keeps growing its FFO per share by 4% annually. So all in all, you're likely set to earn very attractive total returns, and the risk reward is very attractive in my opinion. For this reason, we have heavily invested in EPR. It's today our third largest position at high yield landlord. By the way, if you want to access my entire real money REIT portfolio, you can join us for a 2-week free trial. I'll put a link to it in the description of this video. And before I go into the second REIT, could you please do me a huge favor and click the like button if you think that this content is valuable. It will help me a lot to grow this channel. Thank you so much in advance. The second REIT that I think is offering a once-in-a-decade opportunity is called Big Yellow Group, ticker symbol BYG. I've discussed it quite a few times on this channel, but I want to highlight it again because I just recently bought more shares and I think that it's particularly attractive right now, trading at about 1,000 British pence per share. If EPR Properties is my favorite net lease REIT today, then Big Yellow Group is my favorite self-storage REIT. Before I dive into Big Yellow Group, it's important that you know here that self-storage has been by far the most rewarding property sector in the US over the past 30 years, delivering nearly 20% average annual total returns, and that's despite also being the least volatile of all property sectors. These REITs were so unusually rewarding because the concept of self-storage was rapidly growing in popularity among consumers, but there was not much space available, and so these REITs were able to develop new properties, and they were earning very high initial yields, representing unusually large spreads over the cost of capital. Then on top of that, this is one of the few property sectors where scale is a very big advantage, because it then allows you to do national advertising campaigns, to have a well-known brand, just like Public Storage and Extra Space Storage have. And so you have a major competitive advantage relative to the smaller mom and pop shop. And so these REITs were able to acquire properties from unsophisticated owners. They would then change their brand, include them in national advertising campaigns, also implement some revenue optimization tools, and with that they were able to earn very attractive returns on their investments. But now the US self-storage market has become very competitive. Everybody has witnessed these big returns. It has attracted a lot of new capital, a lot of new developers, and as a result I expect future returns to drop down considerably. This is where Big Yellow comes in. The European self-storage market is still 20 years behind, and Big Yellow is now replicating the same American model on the European continent. It's the leader in the UK, where there is roughly 10 times less storage space per capita, but the concept is now rapidly growing in popularity because the same demand drivers that exist in the US also exist in the UK. People also move around, people also go through divorces, older generations pass behind and leave a lot of stuff for their kids. Now in the post-COVID world, people also want to make space for home office because they're not commuting to the office every day anymore. And there are many other reasons, but the point is that the same demand drivers exist here as well. It's just that the concept wasn't well known in the UK yet, but it's now becoming more popular. According to a survey of Big Yellow, about 50% of its clients are first-time users. They've typically heard about this solution from a friend who perhaps is using self-storage, or from a TV ad, or even from social media. But the point is that the word is now going around that the concept has a lot of growth potential. Big Yellow has been capitalizing on this opportunity in the UK now for roughly 20 years, and the early results have been very encouraging. It's been able to earn roughly 15% average annual total returns, and that's despite suffering a major setback during the great financial crisis because it entered the crisis with too much debt. If you adjust for that period, the total returns will have actually been closer to 20% annually. And the interesting thing here is that Big Yellow is still just getting started. It's still about 20 times smaller than Public Storage and Extra Space Storage, which are the leaders in the US. It only owns about 100 properties. It has another 11 under construction today, which would expand its capacity by 15 to 20%. And again, I think can keep replicating this model for a long time to come. It's earning unusually high yields on its new development projects. It's targeting about 9 to 10% on those that are currently under development. Yet its cost of capital is only about 5 to 6%, so you have here 300-400 basis point spread, which is unusually large for REIT. And so again, this is really the same model that in the US was so incredibly rewarding. The REIT already has proven that it works in the UK as well, and I think that has a long runway of growth ahead of it. But despite that, because REITs are out of favor and it is structured as a REIT, its share price has crashed with the rest of the market and is today priced at a historically low valuation of just around 16 times FFO, a near 5% dividend yield, and a 20% discount to its net asset value. 16 times FFO may not seem that low to some of you who are used to buying REITs like EPRA at just 8 times FFO, but here you need to keep in mind that a lot of Big Yellow's assets today are not earning cash flow yet because they are building these properties. It also owns a large land bank for future opportunities, and so if you adjust for that, the multiple will come down quite considerably. And also another thing to consider is that it's using very little debt. Its loan to value is only 20% today. So again, obviously a REIT that's using more leverage should deserve to trade at a lower valuation multiple. But since this is almost a pure equity play, the valuation multiple should reflect that and be quite a bit higher. Historically, the REIT has managed to grow its FFO per share by about 11% annually. If you add to that the 5% dividend yield, you get about 16% average annual total returns. And obviously, I don't expect the growth to be exactly 11% every year. One year it's going to be 14%, the other year it's going to be 7%. But on average, I think it can keep growing at a high single-digit growth rate or a low double-digit growth rate. And so add those two together with the dividend, you get roughly 15% average annual total returns. And if now interest rates go to lower levels, levels and the market sentiment of REITs recover, I think that you can also add a bit of multiple expansion in there, because this REIT has historically traded at closer to 25, 30 times FFO. If we remain in a higher interest rate environment, that perhaps may be a bit much, but could it recover, let's say, to 20 times FFO? Yes, I believe so. And if you now think that this is going to happen over 3 to 5 years, that would add another roughly 5% of annual total return. So you're getting closer to 20% average annual total returns, which again may seem unrealistic from a REIT, but this is exactly what self-storage REITs have achieved in the US over the past 30 years, and therefore I think that it is attainable. So again, REITs are priced at near their lowest valuations in over a decade, but just like the private equity players who are now stepping up their REIT investments because they think that the window of opportunity is closing, I am as well now investing in more heavily in REITs. And if you want to access my entire portfolio, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it in the description of this video. As I've said before, this is a real 2-week free trial. You won't be charged anything in the first 14 days. So if you want to just come in because you're curious to see my portfolio, that's perfectly fine. If you then decide to stick around with us, you will also enjoy a discount relative to what most other members are paying. And then finally, if you could please do me a favor and click the subscribe button, like the video, that helps me a lot to grow this channel. Thank you so much in advance. See you at my next one. Bye bye.